If I had told you a week ago that if you invest £1,000 into a stock, you would have £18,000 a week later, what would you say to me? You'd probably swear at me. You'd probably say I'm trying to scam you, trying to make you lose money. It would never happen. It's fake. It's fraud. Well, ticker Koss, Koss, the price spiked 1,816% in a week. In a week. You heard me right. 1,816%. I'm still trying to get my head around those numbers. But it wasn't the only one. The one that everyone is talking about, the stock that's been on the front page of newspapers across the world, has been reported about on the TV by news bulletins, is GameStop, which has spiked another 400% in the last week. In the last week. I mean, I've seen some crazy stuff over the years with stocks, but this week, something crazy has happened. And I don't think it's ever been this bad. The short sellers got completely and utterly annihilated. They got squashed. They didn't get squeezed. They got squashed. There was no lemon juice left. It was all gone. All gone. To the point where hedge funds on Wall Street needed bailouts. Melvin Capital needed a $3 billion bailout just to survive because they were massively exposed shorting GameStop. For those of you who don't know what shorting or short selling is, in short, it's a way for people to make money betting that the price of a stock goes down. And what can happen if you're on the wrong side of short selling is that you can make almost unlimited amount of loss if you don't exit a short position that's gone bad. And the only way to get out of a short position is to essentially buy the stock to cover your position. So therefore, people who short stocks and the stock ends up going up, they are part of the chain reaction to make the stock go even higher because they need to buy the same stock just to stop their loss. And that's how you can get parabolic moves up. And you can see that in this chart here, in this very, very first chart, you can see this massive, massive, massive spike to the moon spike that's taken place this week, where the short sellers got absolutely crushed. Now, this short squeeze has been initiated by a Reddit social media forum, Wall Street Bets, where they have been discussing what stocks they would like to pump up the price to squeeze out organizations and individuals who are short selling stocks. And you can see by this first chart here how steep that curve is. Absolutely crazy. And cause, just by sort of comparison, you can see that the spike is almost mirrored. You know, the graphs, the lines are almost identical. See, um, on the 26th, you can just see the crazy amount of volume that's driven that massive surge between, the 26th and the 27th. But what you should be able to notice is that the shape of the patterns are very, very similar. Very, very, very similar. And there are a number of other stocks that have followed this pattern this week and have had insane gains. Insane gains. Now, the question is, can it continue? Can it continue? I mean, I've seen lots of articles about hedge funds and investors, traders alike, who are closing their massive short positions in a variety of stocks to avoid being caught out by the next short squeeze. So it's going to be interesting to see if this can continue over the next couple of weeks, because the news that this is generated around the world, it's almost seen as a movement of the smaller guy taking money from the bigger guy. The good old classic Robin Hood story. And the irony of that story is Robin Hood is an app which enables retail investors to buy and sell shares. And they were caught up in the massive volatility this week as well for their own reasons, which I won't get onto on this episode, but it's all unprecedented. I mean, that word was overused last year, but for a different reason right now, that word just needs to be reused. The title of this episode was Trading versus Investing, and I've had a lot of people ask me, what's the difference? How does trading differ from investing? So I've tried to provide my perspective of this, and I've tried to keep it very, very simple. So with trading, people who trade tend to buy and sell their shares frequently, and compared to investors, they tend to hold positions for a relatively short period of time. So where investors tend to buy and hold shares for years, a trader would probably buy and sell their positions multiple times within a year. And there are different flavors of traders, and there are obviously different flavors of investors. So there's different trading styles. So there are day traders, people who buy and sell shares within a day. So they're not going to hold any shares overnight. Then you've got swing traders who tend to hold shares from 2 days up to like a month, where they're looking to exploit a long-term trend in a particular direction of a share. And then you have position traders who tend to hold their shares for a couple of months, where they're holding out a position over a longer period of time. But that's very different to a buy and hold investor who is looking to buy a share in a company today and look to hold those for several years as a longer term investment. Now, there are two main types of analysis that I consider in trading and investing. There is technical analysis, which is based on price, volume, and other technical metrics that will enable you to identify potential trading opportunities. So it's based on charts, which attempt to illustrate, the price of a share in a given period of time. And you can look at this on a 1 minute chart, 15-minute chart, hourly chart, daily chart, weekly chart, or a monthly chart. But by looking at the chart, and there are various indicators, technical indicators that can help you identify and analyze a stock. Most traders use a form of technical analysis to identify their trading opportunities. Whereas by comparison, investors tend to use fundamental analysis to assess a company's long-term prospects. So fundamental analysis about looking at the accounts of the company, looking at the last couple of years accounts to see if they've been growing revenue, growing net income, has their debt been rising, or is debt being reduced over a period of time? What has their earnings per share been over the last couple of years? What is it projected to be? What's the price earnings growth ratio currently, and what is it projected to be in the future? There are many different ratios that are linked directly to the company's performance. There are also news about future products and services a company might be working on to enable the company to grow further. So it's more about product services and the current and past analysis of the company's performance, and looking at projections from various analysts and your own projections based on the financial metrics of the company to assess the company's long-term prospects. The other thing to consider with trading and investing is the ideology of risk. So trading is considered to be riskier than investing by many people, mainly due to the fact that with investing, if you buy and hold an investment for 2 years, for example, the day-to-day price fluctuations are unrealized gains or losses. So with stocks, if you look at the S&P 500 from the last 20 years, I think the average growth per year over that period of time is about 8%. So in short, what we're loosely saying is that stocks tend to trend upwards over a long period of time. So on paper, the longer you hold a stock, the more chance you're giving it of going in your direction, which would need to be up, obviously, if you're looking to make money by going long on the stock or by the price going up. Whereas if you're a day trader and you don't have a stock going in your direction, you may, because you're only holding it for a day, have to make a loss purely because you're not holding the stock over the next day to see if it can improve. So for that reason and similar reasons, trading is considered to be riskier than investing, just due to the time traders have to make their trades go right. So that is a consideration. But depending on what your goals are and your understanding of the financial markets, that will help you to determine what type you'd probably want to get into. Both need experience, time, and practice to get good at. So there's not one that's particularly better than the other. It's more about what your goals are and how much time you can afford to learn how to trade or how to invest.